Hi, I'm Billy from Whitebrook Cyber. I'm the Offensive Security Director. I'll be your session chair. I'd like to bring to the stage for the first talk Ben and David from WTW and Solid Security about cyber insurance and its importance.
Well, thank you very much. Obviously, room's still filling up, but we figure it's a good idea to get going. So as was mentioned, today we're going to talk a little bit about cyber insurance. What's particularly been a trend the last, I suppose, 12 to 18 months is insurers have been at the front line of where the losses have changed, additional ransomware costs and so forth. So part of the ways in which they've responded and what the market's done gives you an idea of where we think some of the wider approaches are going to be across cybersecurity and cyber risk management. Just a little bit about ourselves today. My name is Ben DeMarco. I work with WTW, so they're a risk advisor and insurance broking team. My background is as a lawyer, so practiced here in the US and also in London. And a lot of the work that we do is quite cradle to grave in this space. So how do you think about risk? How do you manage it? Where does insurance tie in? And then what are the types of steps that you want to do after the fact? Over to my good friend.
Sure. My name's David Ruddick. I am recently retitled the CEO of CFC Security. I've been in the IT and cybersecurity industry for 20 plus years. For my sins, I sold my original company to CFC in April of 2021. CFC are there's a bit of feedback. CFC are a cyber insurer, or they're a global insurer with one of their major product lines being cyber insurance and one of the main insurers in Australia. So my role day to day, we get to see over 2,500 cyber incidents a year, which gives us really good insight into what is causing a lot of these claims to happen.
So today there are 5 ideas that we want to play through with you. Looking at the last 12 months, lots of things have changed. So what does that mean from both the risk and the insurance component? What are the types of things you can expect from the insurance market at the moment? What are the emerging issues that are causing the most concern? How do you navigate it? And then finally, just some recommended strategies and thoughts that we've got on where the industry is going to be moving.
Yeah, now interestingly, do you want to just press one more?
Claim frequencies was what you wanted?
Yeah, but it's missing a line. That's okay. There it is. There is a line going through that to normalise it. If we look over the last couple of years at the frequency of actual claims, what we are seeing is traditionally there is a reduction in the frequency of claims that are happening. If we plot the Russia-Ukraine invasion in the period just before that happened, we saw an uptake of claims. We then saw a drop in claims, and you can attribute that if you like. And most recently, and it isn't shown as much here, but we are starting to see an increase in claims again.
And one thing I'll add too is sometimes the insurance data is different to the wider industry. So insurers record a claim, so that is both the happening of a cyber event but some type of loss that the company wants to claim for. So a lot of the no loss or nil type of events get filtered out and don't appear in the insurer data.
Interestingly though, what we're seeing though is the frequency of claims for ransomware is declining. There has been a slight uptake again at the beginning of this year, which is not plotted on this graph, but we were seeing a reduction overall of the frequency of ransomware-based claims. What we are seeing though is an increase in the theft of funds based claims. So we're talking about business email compromise that results in invoice transactions being redirected, and business transactional fraud as well.
2 quick things I'll add here is the theft of funds happens across some common industry verticals. So anything fintech, anything Web3 based, a lot of the professional and consulting firms. So depending on the types of organisation that you're in, some of these thefts of funds are becoming very frequent, but they're also quite important in terms of the severity.
Oh, and interestingly there, when the sanctions came in for the Russia-Ukraine invasion, we did see the decrease in ransomware claims as well.
So just to give you a little bit of context, when you chat to clients and also to insurers, one of the big things was 2022 was a period of time where the things we've been worried about for a long time pretty much all landed. And if you try and track what happened from January to December, you'll see we've had a number of the largest breaches, particularly Optus and Medibank, which were last year, some very significant ransomware events as well against a second group of Australian companies. There was a lot of concern around loss severity, so business interruption, types of issues around replacement of identification documents and so forth. I've mentioned here some of the issues around the criminal marketplace, but also when we're trying to look at what organisations and senior management are concerned by, a lot of the legal issues have changed. So the privacy reforms, one tranche of that was brought through at the end of last year to increase the penalty provisions. There's also another significant tranche which will come through probably at the end of this year. A number of the security of critical infrastructure obligations have been switched on, so the risk management plan obligations will actually attach to another sector in about a month or so. There's also a lot of movement around what regulators are doing and the types of litigation and regulatory action that we expect there. So the thing that I just want to really highlight here is that if you take the macro lens of claims, it shows you that there were some changes, both good and bad, but when we're kind of zeroing in on Australia, there's lots of things for insurers and for organisations to be concerned by that suggests that the costs of cyber events are going to be more, and also what we need to do to respond and manage them is going to require more resources.
I'll probably add as well, what we saw last year is basically what we'd all been talking about happening for a very long time, and that other markets had already seen, and it was basically Australia hitting the realisation that cyber is this real thing and how we're impacted.
Yeah, and if you track a lot of the major data breaches we saw last year, they pretty much follow the tail and shape of what happened with a lot of the major global breaches. So I think that idea of Australia has just become more consistent with what we see globally proves quite true when you look at the key issues that are going on. Ransomware is a huge focus for the insurance market at the moment, as it is for most organisations. One of the things that I think is particularly important with ransomware is that how we respond to it and how we manage it is different to most of the other types of cyber events that occur. I've given you some ideas here, but commonly when you see major events, there's a lot of issues for the organisation to work out internal accountability, who's got responsibility for triage, containment decisions, relevant business impacts, and also some of the reputational issues. We're finding as well that for a lot of organisations, bringing together the right internal stakeholder group to be part of that incident response or that business continuity team can be really challenging, where subject matter experts fit in points of delegation. The financial risks have also become a major point. So the sanctions law and the sanctions regime is a global regime, but we now have evidence of, particularly in the US, organisations being prosecuted under it. Also, there's the proceeds of crime. There's also issues in terms of a number of the other regulatory obligations that exist. The final one that I'll mention here is that if you look at ransomware events for many organisations, normally when we think about incident response, business continuity processes, disaster recovery processes, they're quite siloed. So normally if it's a physical peril type incident, it's more disaster recovery. If it's a traditional cyber event, we're going through incident response. Maybe if there's availability, it's BCP. Ransomware is hitting all of them, so how governance structures work and the importance of having good governance structures is really, really critical to what we're seeing for good incident response management for ransomware, but also what insurers are increasingly demanding. You can see the statistics yourself. I understand the slides will be shared with everyone, but if you look at it, it just shows the frequency with ransomware and the concerns that exist around it.
Yeah, so the other thing, and these statistics are from CFC, the parent company of the organisation I work for, the average cost per claim has gone up. And it's interesting to point out that ransomware costs have gone up. And if we think about the reason for that, why, many years ago, a ransomware incident was probably like $1,500 for some family to recover their photos that got encrypted. We're now talking about major enterprise being hit with ransomware and those figures being $500,000, $1 million plus. The interesting part of this statistic, though, is that the theft and other only talks to the costs related to business interruption, investigation, legal costs. So there are some missing figures there because of the way that policies typically work within the cyber insurance industry.
Yeah, and I'll just give a teeny bit of context there. So historically, if someone got into your organisation and they did an account or a payroll fraud, you'd rely on something called a fiduciary policy or a crime-based policy. Those policies stripped out how they wanted to manage and cover cyber events a number of years ago. The cyber market for a little while was covering some of those losses, but the difficulty with them is they're almost impossible to underwrite for. So the cyber market will cover investigations, it will cover if there's a consequential interruption, increased costs of working to the business, but it won't cover the pure replacement of the funds that have been stolen. So if you're actually tracking the impact of theft of funds, the overall loss to organisations is much, much higher. It's just right now it's very difficult to find an insurance solution. There's a couple of things that are coming into the market, so specific wordings that'll sit above, different policy classes and drop down. But I think if you're looking at this objectively and if you're worried about theft of funds, it's quite challenging to find an insurance solution that will meet and that will pay that. This is just some data that I think is useful to paint the context of where we are in 2023. So I've given you some of the Black Flag reporting. I always like them because they do some quite good point-in-time analysis. And one of the things that they were doing was they were trying to track the ransomware events across their clients over the last 4 years. I'll start with the yellow line. So the yellow line was really showing 2022. And you'll see up until about May, June, the numbers are down compared to all previous years, well, most previous years. But then there's this increased trend that they point towards kind of August and December of ransomware frequencies. Now, again, because insurers are modelling the claims, it's not always going to be at the same point when the event occurs, but this kind of shows you that the frequency, there's evidence that it was increasing at the end of last year, and that's continuing through to this year. And most of the statistics we've got internally are showing that January and February, globally for WTW clients, have seen the most number of ransomware events that we've ever experienced. I also want to just quickly talk about the second slide, which is from a global claims report that we publish every year. And that big purple circle that you can see is talking about the average losses that fall off the back of ransomware events. So historically, ransomware events didn't have a huge amount of frequency, so they didn't happen all the time, but they had big losses. Now the number of incidents that we see for ransom is the most across our books globally, and also the average size of loss for ransomware is more than any other type of loss across all of the cyber events that we see. So it just shows you that you've got to be focused quite carefully around the financial and the exposure impacts that will hang off a ransomware event. And I've mentioned here that the average first-party cost, that's the cost to investigate and deal with a malicious actor for our book globally, it's up to $900,000 USD. So that's an increase of about 100,000 on what the number was last year. Yep. Yep.
Medibank have reported 46 million in their annual loss report, plus they've got class actions and everything else. And Optus put a provision aside of 140 million. So how does that reconcile with your numbers, which, by the way, seem a little light?
Yeah, so we're talking about average, and we're talking across a global base that includes small SMEs. So we insure clients that might have 1 to 2 million in revenue. And if you actually look at it globally, I think we've got something like 50,000 clients that have cyber insurance. So the average is taken down because for those small organisations, they will still get like a 20, 30, 40, 50 ransom demand. If we were to build this on just like the big game hunting stuff, I can share it with you, but anecdotally, like for that in the Australian market, the average is about 5-6 million. We've got some clients that have had in the last 12 months $15, $20 million demands. And if you want to add all of the loss tail, if you're thinking about regulatory risk, third-party exposures, civil liabilities, they will be much, much higher. So again, this isn't designed to talk about that top end of town, but if you just want to see as an average across all the organisations globally, all of the trend lines point to the fact that it increases and it impacts everyone and all types of businesses.
I'd probably also add into that, Medibank didn't have cyber insurance. So statistically, that particular cost and others that we hear about, this is all based on claim data. So there are a range of, and we'll talk about that in a second, industries that either are very hard to place or choose not to place because the cost, they other reasons, so they won't fall into these statistics.
I think it is worthwhile just talking about some of the key issues that are being focused on following Latitude, Medibank and Optus, because they're obviously front of mind and they're the ones that are really driving a lot of the discussions that we're having in terms of risk management and exposure. So we've given you just some takeaways and some main issues that we've identified and also that the insurance market has identified. I think if you start with Optus, one of the things about Optus was it really highlighted the fact that overall IT risk assessment processes and risk management processes are a key component, particularly for anything that's in like a TMT vertical or as a technology product or service provider. And I think what we learnt from that is they probably are a series of organisations that have a slightly elevated risk profile that we historically didn't understand. The collection and retention point is something that the market is focused on. To be honest, it's still a very rough science. I would say that across all of our clients, maybe 5 of them can accurately predict the amount of personal information records they hold. And even then, I think there's a lot of understating. So we're starting to get to the idea of, can we do proper things around data classification? Can we actually map where these records are? Can we work out some logic around retention and deletion schedules? But the acceptance is there's no great answer. It's just we want to be aware of some of these organisations that are over-collecting so we can build that in because their incident response costs are much higher. The only other thing that I'll mention in terms of Optus is it's one of the ones where we really first started to see the attention from litigation funders and class actions. So Optus has got a series of different ones that they're trying to manage and respond to. There's also issues in relation to both Optus and Medibank where we're not just trying to bring representation proceedings under the Privacy Act, we're trying to go directly through federal courts and other mechanisms and essentially allege things such as negligence in the provision of service. That had never really happened in terms of a major data breach either in Australia or in Asia. So that'll be an interesting trend to watch. I should probably also mention in terms of Medibank that the insurance market, there was no cyber insurance there. So that's one where the market is watching it in terms of lessons learned, but there isn't that same concern around what this might mean for availability and so forth. The other one that I think is particularly interesting with Medibank is we were dealing with a ransomware group, Revel, so we had some live sanctions issues. We had a lot more complexity around decisions of whether to pay or not to pay and how to engage with the ransomware actor. We've mentioned here Latitude. Obviously, some of the issues around how Latitude was actually compromised and the tech service providers involved. That's probably going to be one of the most interesting talking points that we're going to look at. But it's another one where I think it has probably the most egregious over-collection of data. So there's some reports that identify that data was retained all the way back to 1995, including when Latitude was part of a completely different organisation and there were some shared data repositories that probably should have never been shared. Also, I think what's really, really interesting about Latitude is it's highlighted issues around sensitivity. So the data that we've seen is that the financial frauds that are occurring off Latitude are more than what we've seen for other Australian breaches. So how that impacts and where that goes will be an important lesson.
Yeah, but interestingly here, we've got, well, we don't know what's the root cause fully yet with Medibank. That report is still to come, but if we look at Optus and Latitude individually, one, we've got what I would probably call a change management problem, and the other one we've got is a vendor supply problem. And what we're seeing from my side of the fence, as well, and I know Ben is as well, we are now starting to see the vendors are the in point for a lot of these attacks. Obviously questions around how is the vendor's credentials being exposed and all of that, but it is now very much driving a how are you managing your vendor risk, because these are becoming ongoing problems.
Another thing I'd highlight is if we're thinking about lessons for 2022, a lot of the loss elements that we saw in those breaches you can't match to earlier breaches. And I've given you 5 ideas of topics that we talk about a lot with clients and that a lot of our clients are focused on. Particularly off Optus, there is real evidence that there was customer churn and there were lost customers that hung off the back of Optus. So again, there's a number of reports in the Australian and otherwise that referred to numbers between 10 to 15% of customers that were considering leaving or have left. Optus hasn't acknowledged it, but if you track the market sentiment, it's pretty clear that there was loss there. Also, there were a number of different surveys across the industry that talked about the significant loss in customer satisfaction. Again, this is actually reflecting more of the US breach profile where we see customer churn, we see lost customers in that 3, 6, 12-month period. The identity document costs, again, we're becoming more consistent with the globals in the sense that in the Europe and also in the US, off a lot of these major data breaches, we had to incur the costs of replacing individual identification documents. In both the cases of Optus and Medibank and also Latitude, those costs are being incurred. And interesting, we're actually relatively expensive when you look at document replacement costs. So if you want to replace a passport, it's about $193. If you need to do it express, it's about $300. And then the cost of replacing driver's licenses are between about $22 and $42. So they aggregate really, really quickly if you've got big data holdings. And for some of our clients, particularly in the financial services space, this is one of the most significant exposures they can actually quantify very, very quickly, because if you know what the data holdings are and if we've got to replace all of those identifiers, you can very, very quickly work out that there's multiple millions of dollars of exposure that historically was never accounted for. Incident response costs, you might have some views on this, but we've basically seen that across most of the incident response providers, so the legal support, the forensics support, the communication support, you need more guidance from them, you're being retained for longer, and also the overall costs that they're incurring are greater. And also because of the complexity of some of the modern attack chains, it's not just a simple root cause analysis that the forensics provider has to do. And because of that, that's another aggregation of costs compared to what was previously happening.
Yeah, but what I would add there is though, even though I remember having debates with, I think lawyers previously about, in fact it might have been you, about incident response costs being more than lawyer costs at times, I still think our costs are far lower than what we're seeing. And I don't have a slide for this, but the business interruption costs, the payment of ransomware, all those sort of things, and the cost to replace identity documents and provide identity care and all those sort of things far outweighs those costs, but they're still significant.
Absolutely, and look, forensics is probably the key vendor that you need during those early stages. If you want to track the reasons why forensics costs have gone up, parts to do with the attack chain, parts to do with the fact that there's still a lot of supply and expertise shortages, and also the other part is to deal with the fact that we want a higher level of validation now. So if I've got to take a forensic report to ASIC or to APRA or to other providers, it's a different level of guidance and it's a different level of support that I'm seeking from forensics providers. I should mention quickly the threat actor behaviour. One of the things that we found quite interesting last year was, particularly in that financial services vertical, a lot more of these ransomware attacks are trying to include some type of fraudulent funds transfer or some type of fraudulent transaction component. If you're thinking about Web3 and if you're thinking about anything to do with crypto, I would be very, very careful about investing them at the moment, because there's just a huge number of these attacks being reported where essentially, if I can do some type of code injection to the platform or otherwise, I can commit one of these mass frauds and cause huge amounts of financial problem. Also, I should mention that the proportion of double and triple extortions, that's definitely here to stay. If you think about the malicious actor, they're trying to find different ways of getting leverage and also different ways of putting you in a compromised position, and often those components create the more difficult decisions for business leaders. Last thing I'll just mention here is the class actions. There is active book building now, which has happened off all of the major recent breaches. The litigation funders and some of the plaintiff law firms are also being cheeky now, and they're telling you about compensation ranges that you could expect. Normally they were quite quiet and quite silent on this, but for example, and this is leveraging off some stuff the OAIC previously put out, but they're now referring to the fact that for some of these breaches you could get compensation between $500 and $20,000. So you can see that there is this view here that this will be a very, very significant financial exposure. Last one that I should mention is all of the regulators have said that they're going to more actively look at the enforcement mechanisms. APRA is the most interesting one, I think. If you look at what happened with Medibank, Medibank's had to go to a third party and get an independent report. That will likely form the blueprint for any future regulatory action that APRA takes there. The insurance market. There was a lot of talk last year about insurance no longer being viable, about carriers running away from the market, about insurance being too expensive. The reality is often very different from the rhetoric, and in this case here, I think a lot of people who didn't really understand what they were talking about were finding some soapboxes and speaking without really getting the context. There was certainly a problem at the start of last year, if you look at cyber insurance. So ransomware losses had been accumulating. There are a number of books, particularly in the US, that were unprofitable. And what we saw was increases in insurance rates, but a lot of that was for what I'm going to call excess towers. So when you go to the market, you'll get a primary insurer. They're the first one that you tap. They're the ones that normally provide the instant response capability. They might give you $5 or $10 million in limit, but often for the big organisations, they want towers of $200,000, $300,000, $400,000. Sorry, $400 million. And because of that, the excess layers, when they move, can have a really significant impact on how much you're paying. And that yellow line basically shows you what excess insurers were doing. So it was the excess insurance market that really exploded. Some of them were charging twice as much as what they previously wanted, and a lot of that was driving the overall changes that were happening in the insurance market. So primary markets did increase a little bit last year, and in some cases with some risks there was that doubling impact. But if you actually look at where the biggest changes were, it was the excess pet towers. What also happens is, particularly from the second half of last year, the market starts to come down, new competitors enter the market, there's new capacity. Lloyd's issues suggestions to a number of its syndicates that they should be focusing on specialty lines and cyber. And what we're showing you is that it plateaus. Interestingly for us, for the first quarter of this year, insurance costs are flat, and for our good risks, they're getting between 15 to 20% type discounts. So I think the market is starting to stabilise. The only question for us will be, are there going to be a lot of big ransom losses that get accumulated this year? If there are, that may cause a rethink, but there's no evidence. And in fact, you've got new players that want to enter the market, which I think shows you that there's a lot of competition and there's quite a lot of engagement. This has come up quite a bit in the last 3 or 4 months, which is how insurers are thinking about nation states and also cyber events that can occur in relation to acts of war. It was probably a talking point for about 5-6 years, but the Russia-Ukraine conflict really brought it to the surface. And what's really driving this is, for a lot of these types of incidents, we now know that nation-state capabilities and the ransomware groups and the offensive capabilities, they're very, very closely aligned. We also know that if there was going to be a serious act of war, it would involve a cyber-related component. And because of that, you would see nation-states trying to cause detrimental impact on vital infrastructures of the various states that they're in conflict with. The consequences of this is basically if we do lose business of sovereign infrastructure, that will have both the physical impact but also on businesses and also on a number of the cloud and other types of data repositories. If the economy is forced to shut down its infrastructure, there will be very, very significant supply chain consequences, both there and globally. And also what we're particularly worried about is there's a real contagion impact. I think that was really the lesson from NotPetya, that even though you started targeting a bit of software that was just being used by Ukrainian companies, there was a whole bunch of different porous routes it could go through, multinationals and otherwise. And if we were to have one of these major types of cyber events associated with nation-state acts of war, there just isn't enough premium in the insurance market to pay it. So insurers have responded by looking at a whole bunch of different language. There's been a lot of overselling of what this language does. In my view, it's actually pretty benign. So I've given you the 4 essential clauses that are being used at the moment. For our clients, we're insisting on what's referred to there as LMA3 and LMA4. And what they basically say is they say that the exclusions can't apply for acts of war or sovereign state actions unless there is a major detrimental impact on the functioning of a sovereign state. If you think about that as a threshold, there's no cyber event in history that's ever done that. And really, the mechanics of doing that for major economies like the US and Australia, I just think there's a lot of evidentiary hurdles. So I'm not convinced that you're ever going to establish that. But also what we've got with LMA4 is it's not going to apply to a bystanding asset. So a bystanding asset basically means that if you are part of this contagion effect, if you are someone that wasn't directly impacted, but then it flows through to you, because you're bystanding, you'll still be covered. So our view is that if you actually look at this, if you apply it properly, the language doesn't have that big of a detrimental impact. And we also don't see it causing a huge amount of challenge for a lot of Australian organisations. I would say if you're in a government sector, you might think about it differently. And if you're critical infrastructure, you'll want to think about some of the ways in which they come together. But this is one where the mechanics of what the market's doing, I don't think is going to have a huge impact or cause a huge number of coverage problems. These are just some of the risks that we find at the moment that are particularly difficult to place. So managed service providers, they're always a little bit challenging because they're in that IT space. And for IT, a lot of the cyber and the professional service risks can blur. But what we're finding particularly at the moment is a lot of these managed service providers, not only are they aggregating data, but they've got the ability to be used to go down supply chains. So often they have a high degree of credentialing into client environments. And also what we find is that there's a lot of quite sensitive corporate data that increasingly they're storing and that they're holding. I've mentioned here the aggregators of sensitive data, so things like data brokers, data warehouses, some of the big financial service providers. The problem with them is essentially because they are holding this repository of data, they can trigger privacy obligations not just for themselves, but a whole bunch of other third parties. The mechanics of doing incident response is very, very challenging. And also normally they don't have the greatest forms of data governance hygienes around them, so there's a lot of unexposed challenges that get identified as we go through. Subsidiary and related organisations, what you would historically see is particularly for the multinationals, they might take out different policies for different regions. The problem is there's a lot of shared IT infrastructure. There's also a lot of porous transfer of data that goes on between them. So really, if it's a subsidiary, you could be taking on the risk for the parent and all of the related organisations. So insurers are quite mindful of that. Also infrastructure, again, they're very difficult to understand from an operational profile. They tend to almost always have legacy. The legacy is really, really ugly. It can't really be isolated. Also, what we're tending to find is there's more concern around the types of things that nation states will want to do. We're getting a bit close on time. So I'll just finally mention that if you do sit within one of these types of industry profiles or something related to it, you will need to be very strategic around how you think about presenting your risk and also how you approach the market to give them comfort with what you do. Off to you.
So, and the interesting thing there as well, talking about the big risks, the media loves to talk about the latest vulnerability that's done the rounds. If we look at claims trends and the actual vulnerabilities or events that actually caused a lot of claims, a lot of the systemic risks really didn't result in a claim. With the exception of proxy logon, Kaseya and Blackboard, which was more in the US than it was here in Australia. Proxy logon being the great one, which, as Ben and I were lamenting before, also kind of talks to the managed service provider, the vendor supply chain attack, where you had exchange servers, et cetera, that were being compromised and then lateral movement happened as a byproduct. But the main takeaway from this slide is that most threat actors are lazy and they are still using the old techniques to cause these events. and that a lot of businesses just need to get their basics sorted first before they start playing whack-a-mole with whatever the media is running with the latest vulnerability or mass vendor supply chain attack.
Everyone will get these slides, so I'm not going to go through this in a huge amount of detail, but the thing I would say is that people that talk about getting bad outcomes from the insurance market, normally you can point to a couple of problems in terms of how it was engaged and the lack of advice and support that they got. So the thing I just want to highlight here is that the quality of a proposal submission is very important. This is what the insurer assesses. They give you a bunch of ticks and crosses. They put it through the underwriting radar. It says yes or no on what the terms and conditions are going to be. So it's important you understand the questions, you contextualise the answers, and also you appreciate that if you say no to 20 things, that's going to cause some red flags. So if you've got compensating controls or different processes, we've got to highlight that and we've got to communicate it.
I was just going to add to that. The biggest challenge we've got, even though cyber insurance has been around for over 20 years, is most brokers still don't understand it. It is still seen as very much black magic, and it is the more mature insurers who are actually able to help present each business's risk profile and security controls in a way that the insurer actually can understand and say, okay, well, look, maybe they have these legacy systems, but they've taken a mature approach around how they're actually controlling risk for them, as opposed to what is mostly application forms, which is a checkbox scenario. Do you have EDR? Do you have network segmentation? Which has no context.
And the two other bits I'll just add here is all of the insurers still have differences in their language. There are various forms of exclusions and other things that can be used. So you want to actually understand what's the language that's been put up, what's the impact and how does it mean for me, and that requires actually interrogating the insurance broker or the advisor that you're looking at, making sure that they understand and they can confirm that the policy is actually fit for what you need. The last one I should mention as well is that in this particular case here, more and more we're trying to communicate the overall cyber risk management framework. So if I can align what you're doing as part of the wider strategy, the wider uplift, that's a much better way to engage insurers. So that's a more whole approach to what we share, but also it's about being quite tight and quite consistent on the messaging. Again, you'll get all of these, but essentially these are the controls that insurers are interested in. You'll see some similarities with NIST, Essential 8 and ISO. It's not the same. Insurers aren't bound by frameworks. They don't care if you're maturity level 1, 2 or 3 with Essential 8. They will ask you their questions, which is based on what they see driving claims, and your ability to answer that is really what ultimately determines the type of cover and the amount of cover that you get.
And I'll just touch on that as well. Thinking back to the application forms, immature brokers are giving you the insurer's application form, which has a heap of checkboxes. And I literally had a conversation with an MSP yesterday who, because their client has a form that says, do you have EDR? They are selling EDR, but it's the lowest version of EDR because it checks that box. We have to get to a better point. And I can tell you from our side of the fence, we're seeing events where the top tier brand EDR tools were in play, but no one was managing them properly. No one was actually monitoring them properly. And so we expect language will change, where it will not just be, do you have EDR, but is this managed and monitored 24/7 eyes on glass contextually so that we know it's just not a tick box scenario?
These are just some controls that I commonly see answered no, and if you're answering these no, you're in a lot of trouble. So whenever you go through an insurance process, I would be focusing on these points in particular. And even if it's a position of you don't have something yet, but you're actually building, or you've got something that'll land in 3-6 months, really, really important. So backup capabilities, we do want to see immutable backups. We do want to see evidence of different backup sources and locations, the evidence of testing, MFA, ideally something that's separate from Active Directory as well for credentialing and login. Legacy assets, if you've got legacy, we need to have a strategy that we communicate around it. We also need to be really, really clear with legacy that if it's isolated, this is why. If it's not, these are the reasons why. So it's got to be contextualised from both the business and the security side. MFA, I mean, I'm sure everyone here understands this. If you don't have MFA, you're really, really in trouble, both from the risk management and the insurance side.
But Ben, every single time I have an incident, we were just in the process of doing a business test case for MFA and we just hadn't ticked the box.
Yeah.
Anyone else dealing with that?
Yeah.
We're not ready to roll out MFA. It is ridiculous that these are the pay to play. Forget about all the frameworks. If you're not doing these things, you probably won't get cyber insurance, or it'll be, they call it, is it an RMT, where basically you have a certain time frame when the policy is bound to implement these things, or there might be disqualification on the claim or part payment of the claim. So The frameworks are great. We're hearing a lot of Essential 8 off the back of these big breaches, which is an amazing framework. But if you haven't got these things down pat first, don't bother with E8. You're wasting your time.
Yeah, and the last one I mentioned here is ransomware preparedness. So any ransomware specific controls, very, very important in terms of that dialogue. I'm just going to cover this in 10 seconds. Basically, lots of questions around how to be insurable, how do you understand insurability, how do you compare it with other frameworks. We have a process, lots of other people do, but I think it's about client engagement. There's got to be analysis from both sides. And also I think it's really important that we outline what are the controls that insurers want, what does it mean in terms of coverage, how do you actually assess the likelihood of what is going to happen, and finally, it's also about getting some feedback from you and making sure that the insurance is going to be effective. This one here I'll cover in 10 seconds as well. Lots and lots of questions around cyber losses. How do you calculate cyber losses? What does it mean for limits? What does it mean for exposure and balance sheets? We find there are some really common problems with a lot of other methods. There's got to be quality data. It's got to be cross-functional. It needs to be realistic. Don't over-egg it. And also we want to actually think about what it means in terms of realistic recovery type processes. The thing that we do is we've built a number of different cost tables that monitor different sizes of data breaches and exposures. That's a sample of one of them. There's other sources. But I do think more and more understanding the quantum, understanding the losses, it helps with the insurance decision, but also it's the big question that all of you are trying to answer. What's the ultimate risk that I'm trying to mitigate to the company? What does it mean for the balance sheet? And where we can join those together, you're much more effective as well. These are just some different models that we use. If you're interested, I'll chat to you more. But what I'm really trying to say here is that there's a number of different ways you can present this data to different stakeholders within the business, whether it's on the risk side, whether it's the financial side. And more, I think where you do this, you have a much stronger engagement, and it also helps across both risk management and the insurance. That was everything we had. Is there any time for questions, or are we...
Thanks, guys. That was great. I mean, I couldn't stop taking pictures of your slides, so that's good. Just a quick question. Are you seeing any developments more from a supplier side? It's something that we mentioned before the presentation. Are you seeing any disruptive technology coming into the market and changing things? What's the future like?
Yeah, so insurtechs love cyber because if you think about it, there's not this huge amount of actuarial data they can go off, so they've got to be doing predictions, they've got to be doing the analytics. There's a number of them in the US. They've had mixed success. Most of the traditional insurers are trying to incorporate elements of it. I think that the problem with a lot of the insurtechs and the AI is they're normally backed by private equity, so if they have a bad year, they can kind of disappear from the landscape. So it's there, but I don't think it's going to necessarily be the norm in the next kind of 5 years.
I know with what we're doing, CFC, we actively scan portfolio. There's a lot of proactive stuff we're trying to do to de-risk the portfolio, to look for, as I said, those the non-systemic problems that are causing a lot of the claims. We're not the only insurer who are doing things like that, but obviously everyone's doing it slightly differently, because you've got to try and find ways to proactively remove the risk, because it's, we've got an active aggressor. We will see more players come into the market that do that, and it's the only way that insurers will survive is to be proactive. So,
could you all put your hands together for Ben and David? Thanks.
All right.